Hello, this video is over capital structure, in particular how it pertains to the business strategy game. I'm your professor, Dr. Stephen Haggard. So what is capital structure? Well, capital structure is simply how we finance the assets of the firm. And that money can come from externally or internally. The external forms of financing are debt, which we borrow from banks, or issue bonds to receive, or if we issue stock, that would be an external source of equity. And then we also have an internal source of equity, which would be net income that we have earned but have yet to pay out to the shareholders as a dividend. Now I'm going to tell you about 3 capital structure theories. Now keep in mind these are just theories, and they don't predict necessarily what goes on in the real world, but they do help us to understand what might be important. And so these 3 theories that we're going to talk about are the trade-off theory, the pecking order theory, and the target adjustment theory. Let's start with the trade-off theory. What are we trading off? Well, the first thing we need to realize about debt is that it has a tax benefit. Because interest is tax deductible, we can use interest to reduce our pre-tax income and therefore reduce our taxes. Dividends on equity don't share this benefit, and so there is a tax shield to debt that does not exist with equity. Of course, if that were the only thing, we would assume that companies would go with 99.99999% of debt in their capital structure. But we don't see that in the real world, so there must be something else going on here. And we theorize that what's going on is that companies are trading off that tax shield of debt with the expected cost of financial distress. Now we know that an expected value of anything is the probability of that thing happening times the magnitude of the thing if it does happen. So the expected cost of financial distress is simply the probability that financial distress or bankruptcy will occur multiplied by the cost if it does occur. And so what the trade-off theory says is that we are going to trade off for every additional dollar of debt that comes along. We are going to trade off this additional tax shield with the additional cost of financial distress. And we're going to keep adding debt to the capital structure until those things exactly balance out, and then we will stop. Now, why does additional debt increase the expected cost of financial distress? It's because it increases the probability of financial distress. Keep in mind that if you don't have any debt at all, you can't go bankrupt. And so if you borrow money, then it starts to increase your probability of financial distress. If you get to the point where you owe money to everyone in town and you have little assets to show for it, then you're almost a shoo-in for bankruptcy. And so keep in mind that the greater the level of debt, the higher the probability of financial distress, the greater the expected cost of financial distress. Our second theory is called the pecking order theory, and it takes a little different approach. First of all, it starts with adverse selection as its motivation. Now, what is adverse selection? That's where you have 2 parties that have different amounts of information, and the informed party uses their superior information to take advantage of the uninformed party. For example, in insurance, customers can take advantage of agents. Here's an example. Let's say I wake up tomorrow morning and I'm coughing up blood and I feel terrible. In fact, I think I might die. Now you might assume that my first stop on the way into work would be to the doctor. But no, I'm smarter than that. I'm going to my insurance agent first. Now I will of course conceal my condition from the insurance agent, but I will get her to increase my health and my life insurance and decrease my deductible on my health insurance before I go see the doctor. Why? Because I have superior information about my health compared to the agent, and I'm going to use that to take advantage of her. buying insurance cheaper than my true risk would dictate. Now, where's the adverse selection in the issuing of securities? Well, let's think about the parties in that transaction. First of all, we have the managers. The managers know what's going on inside the company. The managers know what the next earnings announcement is going to be. The managers know about problems that have yet to be made public. And so if the managers think that their equity is overvalued, then they are more likely to issue new shares. And they are also more likely to use their shares for acquisitions. Now, investors aren't stupid. They know that this incentive exists. And so anytime they see a manager going out to issue new shares, they immediately assume that the shares are overvalued and the value of the shares drop accordingly. We actually see this in the real world. When a firm goes out and issues new equity, their share price goes down. So, if you're a manager and you're trying to maximize shareholder wealth, you want to avoid sending that bad signal. And so, how would you order your financings? Well, your first choice would be to use internal financing, which would be the addition to retained earnings. Now keep in mind, addition to retained earnings is just net income minus dividends. We're going to use that money and we're going to motivate this part with the agency theory. Managers don't want to go out and issue new debt or equity because that would mean bringing in new investors, whether they be lenders or shareholders. And new investors means additional monitoring or people keeping an eye on you. Human beings don't like to be watched. I don't like to be watched. And we're not necessarily even up to anything bad. But especially when you plan to do something bad, you always want to make sure you're not being watched. And so managers are humans. They're going to go with these internal sources of funds first. Now let's assume that they've got a great project. They would maybe need more money than they can have from internal funds, so they would step outside the firm and borrow the money. Why are they going to borrow the money if it's a great project? Because if they used equity, external equity instead, they would have to share the gains from the project. If they just go out and borrow the money, they only have to pay the interest. They don't have to share these magnificent gains. And so borrowing the money externally does not send the same bad signal that issuing shares would. Issuing shares basically says, hey, we would like to share something with you all. And if you know anything about the scumbag nature of humans, you know that people don't like to share good things, and they do like to share bad things. What do I mean by they like to share bad things? Have you ever heard the statement, misery loves company? That's all about sharing bad things. And certainly managers would love to spread the losses associated with their new project over more shareholders, because that way they're hurting themselves and their current shareholders less than they would if they funded it with internal funds or with debt. Finally, we get to target adjustment theory. Now, target adjustment theory is actually motivated by the trade-off theory. The trade-off theory says basically that there's an optimal capital structure for every firm based on what's going on in its industry, and that the firm should make that optimal debt level its target, and then try to maintain that target debt level over time. Now, why would we see firms drifting away from their ideal total debt ratio? Well, the answer, there are a couple of answers. Number one, if the firm is profitable, even if they're not paying off their old debt, the total equity at the firm will grow as addition to retained earnings grow, assuming they don't pay out all their net income as dividends. And therefore, what we'll see is the total debt ratio will actually drop as total assets increase while total debt stays the same. Also, debt over time matures. And if we don't replace that debt with new debt, then the total debt ratio will once again drop. Now, why would the total debt ratio at a company go up? Well, they could be going out and borrowing money when they shouldn't be, or they could simply be unprofitable. And that negative net income becomes negative retained earnings, which leads to a reduction in the owner's equity, which leads to an increase in the total debt ratio. Now, how do you cure that? Well, you go out and issue some new shares to recapitalize the firm. How do you cure the problem of having too little debt in the capital structure? Well, you go out and borrow some money, either from the bank or issuing of bonds, and you use that money to repurchase shares, because this increases total debt and decreases total equity at the same time. So how do you finance growth at your firm? Well, there are the ways we've already discussed, that you have money for your capital structure. Those are the ways that you finance your growth. We've got the debt, which we can raise externally, and we have equity, which can either come from our retained earnings or from new shares that we issue. So, how do we choose the right source of financing for our firm? Well, we like internal equity because it doesn't bring additional monitoring, and it's the cheapest for profitable firms because there are no flotation costs associated with it. But it's going to push your total debt ratio below the target if you use it by itself, and you'll be giving up that tax shield of debt. Now, debt, going out and borrowing money to finance your project, it has that tax shield. That's good. It doesn't require the sharing of profits. That's also good, but it's going to push your total debt ratio above the target if you use it by itself, and it's going to increase the probability of financial distress, which is going to increase the expected cost of financial distress. And you'll notice that your credit rating starts to deteriorate, and the required interest rate from your lenders will go up. And finally, we have external equity, and that's where we go out and issue stock. Well, that dilutes your current owners. It requires the sharing of profits, and it sends a bad signal to the market. These are all bad things, and so you want to issue stock as your absolute last resort. Anyone who, in the first period of the simulation, decides to go out and issue a bunch of stock is an idiot. There's absolutely no reason to do that. It's only when you have no other option that you should go out and issue new stock. So how do you manage the capital structure at your firm? Well, figure out the target debt ratio at the beginning of the simulation. I think it's around 40%. Use that as your target, and you want to finance your plant and equipment using internal equity and enough debt to maintain your target debt to asset ratio or total debt ratio. You can grow faster this way than you can on equity alone. Let me explain to you why that is. Let's say that I have 60 cents in retained earnings. I can use that. If I only use the internal equity, I could grow my assets by 60 cents. But if I also use enough debt to keep my capital structure the same, then I can go out and borrow an additional 40 cents. And so I can buy $1 worth of assets instead of just 60 cents. And as a result, I can grow the firm 2/3 faster if I take this simple step of borrowing money to keep my capital structure in line. We also want to replace old debt as it matures with new debt, because if you don't, once again, your total debt ratio is going to go down. And sometimes, worryingly, students don't even realize this is going to happen. And as a result, they end up basically running out of cash. And so they end up with an overdraft loan, which is going to cost them 2% more than if they had just borrowed the money to begin with. So always replace your old debt as it matures with new debt. Now let's talk about what free cash flow is. Free cash flow is what's left over after you have paid all of your operating expenses and used and invested in all your positive net present value projects. You want to use that free cash flow to pay and grow dividends to meet investor expectations, and then you want to set out to repurchase stock. But you should not make it your goal to pay off all your debt. Dave Ramsey, there are a lot of people that believe in him very deeply. But this is not Dave Ramsey's world. We are working on a corporation here, and debt has a tax shield attached to it. And so it would be insane for us to get rid of all of our debt. So what are the benefits of stock repurchases? Well, if you leave too much cash in the checking account, that's a poor investment of the shareholders' money. And remember, after all, it is the shareholders' money, and your goal is to maximize their wealth. Both stock repurchases and dividends will decrease equity, which is going to increase ROE if the net income stays the same. But only stock repurchases reduces the number of shares outstanding, which will also help out our EPS. Now, you may have noticed in the Player's Guide that investors have an expectation for ROE and EPS. And so greater ROE and EPS can help your stock price. However, you need to be careful, because if you are using all your money for stock repurchases and you're not growing the firm, you will actually be hurting your stock price. Or if you're going out to borrow a bunch of money to do stock repurchases, you will be making your firm riskier and riskier, and that will lead to an increase in the required return for your equity, which will lower the value of your stock. You should see my video on stock price drivers to understand this situation more fully. What conclusions can we reach from all of this? Well, first of all, the goal of financial management is to maximize shareholder wealth. And so what we should be doing is managing our capital structure correctly to try to achieve that goal. Don't just let your capital structure float. What do I mean? Oftentimes students just run the business, play the game, and they don't think about their capital structure. And at the very end, they realize that their total debt to total asset ratio, or total debt ratio, is down around 5% when it should be up around 40%. Look at it in every single period. Make the necessary adjustments. Don't pay off all your debt. I know it's tempting, but don't do it. Don't do it. Try to maintain that target total debt ratio that you set at the beginning of the simulation. Look at it every single decision round and make the adjustments that are necessary. And as I always say at the end of all of my videos on the business strategy game, read the flippin' Player's Guide. Oh my goodness. It's full of great information, not only about the game, but about business in general. There's nothing in there that would not be beneficial for you to read, even if you weren't playing the game. So read the Player's Guide. I have totally lost count of the number of times a student has told me that the reason that their team did well on the simulation was because they read the Player's Guide. Read it and do yourself a tremendous favor.